Ian, what's up, buddy?
What's up, brother? How you doing?
Not too bad, not too bad. What we got in store for today?
Well, we're doing a remote one today just because of circumstances, but sometimes we got to do these remote ones to bring in some of the best guests that we can find within the real estate industry and business world as general. If we're gonna have the number one podcast for real estate in the nation, this is what we got to do, right?
Number one.
See, I'm trying to manifest it with you, but let's just cut right to it because our guest time is very, very valuable. I met Brady out at a mastermind event. Again, another benefit of going to mastermind events. And he was one of the presenters. And, there's not many accountants that I can say, I'm like, man, I can hang out with this guy. I can go hunting. I can go fishing. And, it's like he got the whole real estate game and he understood business and he really showed what he was capable of. And I just thought a lot of the conversation we had that day was too valuable not to share with everybody in our audience. So, with that being said, why don't we bring in Brady all the way from Salt Lake City, Utah?
Brady, how are you?
Good. How are you guys?
Good. What are you, 2 hours behind us?
Yeah, 2 hours. 8 o'clock.
8 o'clock. If you're watching this live, we're recording this 10 a.m. East Coast time, 8 o'clock Mountain time. So go ahead, Ian. You going to jump in with something?
No, I was just trying to figure out.
I just want to say, like in your video that you guys start the podcast with, Ian doesn't have a beard.
I do not have a beard. Yeah, and that's a
good looking image.
Yeah, that was that was pre-retirement days when I had to be cleanly shaven all the time, and this is just years of rebellion. 15 years of having to be cleanly shaven. So that's why I'm growing it out. But either way, we're here.
That's where that comes from.
Yes.
We're gonna say it took you 15 years to.
I was gonna say wisdom. He said rebellion. I was gonna say wisdom.
Yeah, it makes sense.
There you go. Well, I'm glad someone's positive on this podcast, keeping it straight. So, but Brady, you want to just introduce yourself, who you are, where you're from, and what you do?
Yeah, I'm a tax accountant. Like that's when you cue in the music.
Hey, that's a sexy topic for us. If you like for newer real estate investors that haven't really gotten started or they've only done a few deals, that's not sexy. They just want to know where the shiny object is to make money. But for seasoned real estate investors and guys that are doing business, which a lot of our audience does business, like they want to know the secrets.
No, yeah. So I born and raised here in Utah. To be honest with you, don't know that I'll ever leave to live anywhere else. But I kind of I honestly got tripped and pushed into taxes. I never thought I'd be kind of like a pocket protecting, pencil pusher kind of dude. But that being said, I got into the finance world through school. That's how I kind of got introduced to it. And then I fell into accounting because my father-in-law, he owns a business, and his accountant was like, hey, I need to hire people. And I was like, what the heck? You're going to pay me more than I was working in title at the time. And I was like, I'm going to make more money there anyway. So I was like, might as well try it. And then I fell in love with it. The thing that I really love about taxes is there is so much you can do to not pay them that they just don't know what to do and how to do that. And so I felt like I could provide a lot of value in teaching people how to not pay taxes. So I worked at that firm for a number of years. And then just over 2 years ago, I left and started my own tax and accounting firm. We're based out of Draper, Utah. But I would argue that we have more clients outside of Utah than we do in Utah. So in fact, I was in Orlando yesterday with some clients and had a good time there. But yeah, we specialize in kind of the real estate realm. We also work with kind of e-commerce or crypto individuals, and then a lot of Salesforce, real estate, solar, pest, etc. Those are kind of our main niches.
Yeah, I think for those that don't know, I think it's a valid point here that Utah in general, based on your demographics, you guys have a lot of people that go out and do a lot of door-to-door sales, and I think that's where you get some of that niche from, correct?
Totally. Like you could argue that the largest door-to-door or the most influential door-to-door company, which is Vivint, was started here, and that's where the majority of your quote-unquote sales or summer sales companies are based out of. So.
Yeah, no, I'll tell you what, I'm not going to lie. So I flew out to I flew out to where did I go? I went to Salt Lake to visit you guys to go to that event, and I was like, Salt Lake City, just a little town, dude. When I got at that airport, I was blown away, and I can't believe how much big business, because there are a lot of big call centers. There's a lot of sales. There's a lot of things going on in your town, and I'm sure you guys are getting the big California boom and everything else on top of that.
Yeah. Well, the tech, like they deemed it, the Silicon Slopes, the tech industry is. It's exploding here. It's awesome. So
let's dive into some broad tax savings advantages of owning real estate. Why don't we start with that? So, typically in the real estate world, there's a few different ways that things are taxed, right? Like, sure. You flip a house, you're paying, capital gains tax on that. You wholesale a property, you're paying capital gains on that. And the real magic and the real benefit happens when you actually own the real estate. So maybe let's just talk about the basics of investment real estate and some of the advantages.
Yeah. So can I make one correction on what you said real quick?
Absolutely.
So, and I'll preface this by saying any type of income is either active or passive, right? So a lot of the benefit does come when real estate is quote unquote passive, but there is also some benefit when real estate is not passive, when it is active. So when you flip or when you wholesale, that is actually active income, right? So it is not capital gains. It's active income with inventories and expenses, just like any other business. So we can kind of get into that in just a little bit, but we can start with kind of the passive long-term rental real estate game, whether that's storage or single family, multifamily, whatever that might be. And I'll start, and we can kind of dive into this a little bit deeper, but real estate is one of, if not the only investments, business, active or passive, where you do not pay federal taxes right now, in the future when you sell the property, and in the extended future when you die. Like you literally, it is set up right now, the way the law is set up right now, you literally do not pay a federal tax. Now, that's not to say that you don't pay property taxes or you don't pay employment taxes if you have property managers. Federal tax-wise, you literally should not ever pay taxes if you do it
right. Yeah, and I think that's the big beef that a lot of people have with our past president, Uncle Donald, that, he doesn't pay any taxes, but, he was using granted, he had some other losses, but real estate is one of the best tax advantage industries out there. I mean, do you think there's a better one out there that is more tax beneficial than owning rental real estate?
From an investment standpoint, no. I don't, because you literally like I said before, you literally do not pay taxes. So from a tax perspective, is there a better investment? Absolutely not. From an ROI perspective, and I'm sure you guys have talked about this before because I've heard some of your podcasts, cash on cash returns can be exponential, because not only am I, and not necessarily cash on cash, but total ROI on a property, not only are you getting cash flows, which you always want a cash flow is king, but you're also gaining appreciation on money that you never invested, right? You buy a property for $1 million, you only have to put maybe $200,000 down on that property. You're still gaining appreciation on $1 million worth of property. You're not gaining appreciation on $200,000 worth of property. And all of that can be tax-free. As with a stock, you got to capitalize that. There's no way to trade that stock for another stock like you can do with real estate. So from a tax perspective, no, I don't think there is a better investment.
Let's expand on the first thing you talked about, so people and a lot of people know, but the ones that maybe don't, or they're still confused, let's break it down maybe on one property that somebody buys it, like, because obviously the depreciation is offsetting is the reason that it's offsetting income that could be taxed. Like, do you have a kind of a formula or kind of a scenario in your head related to, like, cool, this is what happens. Somebody buys a property for $100,000. They rent it out. Do you have kind of a go-to for explanation purposes?
Yeah, I'll use a property that I bought not too long ago. It was a condo. Now the play with this condo for me specifically was appreciation, and I'll talk about that in just a little bit. But for me, this condo, it was like $220,000. We put 10% down. Right, we got a great loan opportunity on that condo. We put 10% down. Now for us, we rented that condo. It was kind of like in a college town, so we rented that condo to a bunch of students. We cash flowed about $900 a month. So our mortgage was $1,150, and we were just at the $2,000 mark in rental income. Okay. Now for us, that rental income was great. That was actually our first property that we had purchased. But that rental income was great. Now on paper, so we'll kind of start with now, why people shouldn't pay taxes now on their rental income. Right now, rental real estate on paper should always be a loss. Every single year, it should be a loss on paper. Not because you're losing money. You never want to go into an investment where you're losing money, but because on paper, there is a cashless expense referred to as depreciation that people can utilize to offset the income and not have to pay taxes, and sometimes even receive a greater tax savings because they can utilize those losses to offset other incomes, right? So on paper, we were making, total gross rents $24,000 a year after we deducted our mortgage interest, property taxes, insurances, the HOA fees. We were still cash flowing about $8,000 a year, right? About $9,600 a year. But because we paid $220,000 for this property, we were able to recover the cost of that asset every single year for 27 and a half years. And that deduction alone was enough to offset that $9,600 difference between our income and our expenses to make it show that we made no money on paper.
Yeah, and that's the power of real estate right there. Then you start layering in some refinances or whatever else. You start taking more money out tax free while you're getting your depreciation. I guess based on this thing, there's a couple different.
Let me jump in real quick 1 sec, just to loop that together, and that's because you took that $220,000 purchase price, you divided it by 27, and that got you to $8,000 a year, which you were as the depreciation.
Correct. Okay. Yes, that's correct.
Yeah, technically less the land value, but that's technical crap, and that's kind of where I was going to go on some technical stuff. In that situation or some larger assets, while we're on the topic of depreciation, I know cost segregation's quote unquote ending this year. Really, it's just going from 100% bonus depreciation down to 80% next year, I think. Can you just clarify some of the benefits of cost segs on some larger properties? Because it's like one of those terms that's just getting tossed around. It's just cost seg. But I don't think people understand the benefit of cost segregation right now.
Yes. So I'll start with depreciation in general, because a cost segregation is depreciation. Depreciation, for those of you who are new to that term, is a cost recovery. When you purchase an asset, typically an asset, whether that's a car, a piece of equipment, or a piece of property, real estate, costs a little bit more, right? A car is going to cost you $30,000. A piece of real estate could cost you $1 million. And the government says it doesn't make any sense for you to take that entire expense in 1 year. In some instances, we can. Bonus depreciation is a great example, Ian. But the government is like, hey, why we're going to give you the benefit and let you claim a part of that cost every year for a certain number of years based on how long we think that asset will last, right? So for like a vehicle, you can take that cost and divide it over a period of 5 years and take that portion every year for 5 years. Now, that is depreciation in a nutshell. Cost segregation it is specifically for real estate. And what it does is it says you've purchased a property or a piece of real estate for $500,000 or $1 million, right? $500,000 or $1 million. And the entire property is probably not going to last you its allocable life of 27 and a half or 39 years. There are other aspects of that piece of property that might need to be replaced in 5 years, right? Maybe appliances or electrical. The roof might only last you 15 years. So what a cost segregation does is an engineer and an accountant go into the property and they allocate costs to the different assets within that property, right? Your footings, your foundation, your structure, that is probably going to last you 27 and a half for residential or 39 years for commercial. But things like your roofing, your appliances, your flooring, electrical, plumbing, those items are going to last you 5, 7, or 15 years. And then in that cost segregation study, what they do is they allocate or they increase the expenditures to those depreciable lives of 5, 7, or 15 years to increase or front load a lot of your depreciation expenses. Okay. Does that make sense so far? Any questions so far, Marian?
Yeah. So in essence, you're one-offing individual things, so you don't have to wait the 27 or 37 years to depreciate the whole thing. You can depreciate it in a way shorter period of time, and depending on where you're at, that could really benefit you from eliminating taxes.
HVAC equipment's a good example, right?
Yes.
Take it from 27 down to 15 or 10. I can't remember.
It's either 12 or 15.
Yeah. So, and I don't know if you're going to continue. So the benefit is now you've moved all this depreciation forward, and those of us that have active income, i.e., we're selling something, we're wholesaling, whatever it is, we can offset some additional income from that. And I don't know if you could just take 2 seconds and discuss the depreciation recapture at the time of sale of your property, because I think that's where some people get lost, kind of how that works and why people feel like they're getting taxed more at the end versus on the front side, and how all this kind of ties together.
Yeah. So to kind of back up just a little bit. Yeah. So like, for example, if you went and purchased a property that was $1 million, really what a cost segregation is going to do is it's not going to say, hey, we're going to allocate that $1 million over 27 and a half years. We're going to front load 40, sometimes even 60 or 65% of the cost of that property based on the different assets within that property into the first, 5, 7, or 12 or 15 years, right? Now that can be huge. That can be the difference between claiming a depreciation deduction of $5,000 and a depreciation deduction of $250,000 even in year one, right? With bonus depreciation right now. And for some people that can be huge. People wonder, why did Donald Trump never pay tax? That is the reason why Donald Trump never paid taxes. He just used depreciation on his assets and front loaded those expenses to offset other incomes, right? He went and made millions of dollars in The Apprentice, but because he's a real estate professional, never paid taxes on that income that he received from The Apprentice because all his real estate offset that, right?
Wouldn't that be two different income types though? You probably know where I'm going at with that, but I'm trying to explain it the right way. Because that's something.
Well, it ties right along with Ian's question, which is kind of where I'm going. So there are 3 classifications when you invest into real estate. There is a passive investor, there is an active investor, and there is a real estate professional. Okay. None of my clients, unless they invest into a fund or a syndicate and are limited partners, are passive investors. There are no tax benefits for passive investors. You can't use any of your losses to offset any of your other active incomes. Okay. There is an active investor, which means I have some say. I can depict what rental costs should be. I can say what terms should be. And there are some tax benefits to active investors. If you make less than $150,000 adjusted gross income, you can utilize your passive losses to help offset some of your active income. Okay. So for the most part, like I said, all of my clients are at least active investors unless they're an LP in a syndicate or a fund, in which case, they're most likely a passive investor at that point anyways. Now, the third option is a real estate professional. And this is the mother lord of them all, right? Because as a real estate professional, I can use 100% of my losses to offset 100% of my active income. Now, the caveat with being a real estate professional is that there are a couple requirements that you have to fulfill in order to become a real estate professional from a tax perspective. Okay. That has to be my primary source of income. And you have to spend at least 750 hours during the year in that activity. Or if it is not your primary source of income, okay, and you have to differentiate these between activities with what you're doing, but you have to spend 750 hours more than another activity that you're doing outside of real estate. Okay. Question, Jason, you look like you've got your wheels turning.
Yeah, no, I mean, I get most of this. I want to bring this home because this is something I had to learn years ago, right? And I'm not a real estate professional. Yeah, I wish I was. I mean, we run a lending company, so it's my full-time job is not owning real estate. Do I own real estate? Yeah, but that's not my full-time job at all. So let's try to relate this to. I think a lot of people that are listening own a good bit of real estate, but they also have full-time jobs.
And so, okay, can I use you as the example?
Sure.
I'll use you as the example, and I will show you how you could become a real estate professional. Okay. Are you married or are you single?
Married.
Does your spouse work?
No.
Why not?
It just doesn't.
Why does she not help you manage your properties? Why does she not help you look for listings? Why does she not spend 750 hours a year in real estate and make that her primary source of income? Because once one spouse qualifies as a real estate professional, both spouses qualify as a real estate professional.
So they need to spend 750 hours per year. So how much time is that? Like
that's
how many hours a week?
That's like working a 6-hour job per week. I mean,
so it's 6 hours per week.
Well,
no, it's 52 weeks, 12 hours, right? 15 hours.
So 750 divided by 52, that's 14 hours a week.
It's 14 hours a week.
Is your wife watching? I just want to know if your wife is watching.
What is if we don't buy any real estate through those efforts?
No, but that includes Brady.
But that includes, like, do you own the real estate with your wife? Depending on your entity structure, how is your real estate held? Because if that's all in a partnership and your wife is receiving income from that partnership and she's spending at least 750 hours, but that's a planning aspect that I take clients through. As I say, and this is a perfect example for anyone that's listening, and we're using Jason as the example. You might not be a real estate professional, but your spouse definitely could be. Yeah. She can help you manage the properties. She could look for new listings. She could help decorate the properties. She could help. I mean, the list kind of goes on and on and on, but you're kind of getting my gist. Is now you can utilize all of those passive losses to help offset all the money you're making doing lending.
Jay, let me frame it for you. One more shot at this. Brady, if Jason's wife is managing their family's wealth, investing into several different syndicates and passive investments into some other properties from some operators that operate storage, you can kind of get the gist of this. Would that be a case of managing their real estate investments to qualify as a real estate professional?
Mm-hmm. Make her the managing partner of your partnership that holds all of the entities that own your real estate. Absolutely. Why wouldn't it?
Technically, she is.
You just saved a ton of money by switching to Geico.
What? All right, so let's
15% or more on car insurance.
All right, so let's take me out of this because the situation's obviously a little bit more complex.
Sure.
So, and I want to keep it simple for I think a lot of our viewers. So a lot of our viewers have full-time jobs. They also own real estate. They flip some properties a year, and they also own a rental portfolio. But they enjoy what they're doing. Sure. They either have a government job, they own a home improvement company, they're a builder, whatever it is. They have a W-2. They have W-2 income over here, and then they own flips and rentals over here. What typically would that be said? Because the argument currently is that I guess that's technically their an active. Are they active or are they passive? I guess they're active.
Yeah, they would definitely be active. Now, whether they can utilize any losses generated from their investment activities in real estate depends on how much money they're making from other sources of income. If they are not a real estate professional or their spouse could not be their real estate professional.
For the rules of 150 grand, right? Is that what it is? From the
dollars.
So let's say they make 200,000.
So in that scenario, and they are not a real estate professional, they will not be able to utilize any losses generated from rental activities to offset other sources of income. That's not to say, and this is going back to one of Ian's first questions, this still makes rental real estate a wonderful investment because you're still not paying taxes on any of the income derived from rental real estate.
Yeah. And you're banking any additional losses for future sale or whatever
future gains.
Correct.
Right. Yes.
You just can't take losses. The only way to take off losses is through gains, right? To offset the gains.
Correct. Now going into Ian's question, which was depreciation recapture, what happens on the sale? Because we can kind of move from, we've figured out the now transaction. What happens when I go to sell it? Because we know that with like a stock, you have to pay capital gains tax on the sale of that stock. With real estate, with rental real estate, and I'm going to leave out the wholesaling and flipping. That's active income. That's a little bit different than your rental real estate, Airbnb kind of.
Even as a real estate professional, there's no way to offset that.
Correct. Not through what I'm going to talk about 1031.
Okay.
Right. Okay. Because when I have real estate, I take the asset as a whole and I can exchange it for a new asset. I can essentially roll my appreciation of that property into a new property and use that as my payment into the new property. So I could trade, I'll use an example. Let's say you buy a property for $1 million. You put 20% down, $200,000 into this property, and you've owned it for 5 years. You know, let's say you did a cost segregation and you have utilized another $200,000 of depreciation expenses to offset it. In this instance, what is going to happen at this transaction is you are going to have a recapture on your depreciation, right? And it goes against your basis versus what your gain is. Now, any depreciation always reduces your basis in the property. Okay. So when you go to sell it, you might have a lower basis because you've already received the tax benefit from depreciation. So when you go to sell that property, you're going to have recapture. It's going to reduce your basis, but you can still roll all of those gains into the next property so that you don't have to pay capital gains on that property when you transact and exchange it for another property.
Yeah. And something I learned, and if you could clarify this, when you 1031 in, you're picking up your AM schedule kind of for your initial capital contribution, right? Like I'm not saying it right. You know what I'm getting at?
Yeah, there's essentially the easiest term to use is an adjusted basis. You have to factor in an adjusted basis for the new property because of the initial capital contribution into the property, the depreciation that you've taken, what the new basis is of the new property. So it does adjust your basis, and that in some instances, depending on what is going on in that property, can be somewhat complex. But that's why you hire someone like myself to do it for you.
Yeah, well, this is exactly it. And like when Jason says it, we both learn this stuff in real time. You know, Jason's a little more, you know, he's on the active side, so he knows a lot of the tricks and tips, you know, with saving on that side. And I've learned a lot on the rental real estate side. I'm like, oh, well, if we do this, and this, like I tell them all the time, dude, if you're paying taxes, you need to buy more real estate, right? Like that's the game. It's just mentally what works for me. Now
to that effect, Ian, like, because this kind of does highlight part of Jason's conversation a little bit earlier with it's a little bit more complicated than that and just buy real estate to help offset taxes. So going back to that conversation a little bit, just buy real estate actually does make a little bit more sense because as you buy more real estate, as you take your income and purchase more real estate, that real estate actually should get to a point where it offsets income derived from other sources. passively, right? And I know your whole mantra, Ian, is you want to take individuals who are men and women serving in the fire as a firefighter, which I think is a great tool that you're using to help them create passive income and cover the income that they might be making being a firefighter. But in this instance, buying more real estate does make sense because you can get to a point where you do become a real estate professional and you do make that an active source of income. Not active in the sense where it's subject to self-employment taxes, but active in the sense where it is your primary source of income.
Yeah, and I think that ties Jason's point of like wholesalers and flippers is that they could buy rental real estate, but they're still going to be subject to, at the very least, the self-employment tax, right? Like there's no way to really get away that one, but your passive can offset a lot of the other stuff.
Correct. So kind of going into the wholesaling and flipping perspective, wholesaling and flipping is considered an active income activity. So any income derived from wholesaling and flipping is subject to self-employment taxes. When I say subject to self-employment taxes, I'm talking about Social Security and Medicare taxes, right? 15.3%. You might as well bend over. But at that point, what we can do and what I actively help other individuals do is we want to make sure that you are creating proper entity structures, that you're creating the right taxed entities to make sure that you can reduce the taxes generated from wholesaling and flipping activities. Instead of maybe looking at specifically an LLC, maybe we might want to consider an LLC holding structure owned by S Corporation, because your S Corporation is going to help you reduce your self-employment tax. And then at that point, it's a different accounting structure, making sure, because your properties become more of like an inventory, a deductible inventory with active income and expenses in the wholesaling and flipping activity. But yeah, to your point, Ian, these individuals who might be wholesaling and flipping might also be considered or could be considered potentially real estate professionals in the sense where they have passive holdings on the side that they're involved in so that they can utilize those losses to help offset income earned in active activities through wholesaling and flipping.
What describe? I know you said a lot of people aren't passive investors in related to tax perspective, but what would be an example of that?
Of a passive investor?
Yeah. So between active, passive, and real estate professional.
Yes. So someone who is passive, by definition, gives their money to someone else to invest it for them.
Okay.
Right? This and like I highlighted before, typically this would involve like a syndication, right? You guys raise capital in a syndication, and those individuals typically do not have a say as to what properties are invested in with the capital used. They have no say as to how much they're going to charge for rents. They really are very hands off. They make no decisions. They just get their K1 and any distributions given to them throughout the year.
And I guess what's the disadvantage of that on a tax perspective? Because they can still offset.
They can only utilize the passive losses to offset passive income if they have it. So we call them pigs and pals. This is nerdy for one sec. Passive activity losses will offset passive income generators, right? But they will not offset active income generators.
And a passive income generator would be let's say a sale of that property down the road, right?
So no, because at that point, a sale of the property would be considered a capital activity subject to capital gains. So it's different. A passive activity could be ownership in a business that you're not an active member in. Let's say, for example, Ian, you owned part of a restaurant. Okay, you put some money with somebody's into a restaurant, but you are a limited member in that restaurant. Okay, you just put money into that. And then on the side, you invest into syndicates or funds, right, that are generating losses because we're utilizing depreciation and things like that to help offset the income generated. That income activity through real estate could offset your passive investments into other businesses, right? So for individuals who do have a higher net worth but don't want to be hands-on in their real estate, this still makes sense to invest in real estate because you can still use these passive losses to offset other business passive investments. Right? Now, to go for it, does that make sense, Jason? Does that answer?
Yeah, well, because we're passive on some of our business entities.
Sure.
And that makes sense because some of our entities are income generators. We don't really do much in them.
Yeah.
And sometimes it's a question mark is like, is this going to be an active? Are we going to pick this up as active or passive this year?
Yeah. And the whole active versus passive from a non-real estate perspective, it just depends on how much involvement you do have in that organization or in that business.
Yeah, exactly. This makes a lot of sense. All right. One other question that I think is going to be beneficial on this exact topic. I think a lot of the folks listening that invest in real estate are also real estate agents. They're realtors. Their primary income, their primary job is realtors. Plus they own rentals, flips. I'm guessing because I don't think, and maybe I'm wrong about this, but a real estate agent is not a real estate professional, correct? It's just active.
They can't. Yeah, they can.
They can be.
Absolutely.
Okay.
Yeah,
so that's good.
Yeah, 100%. And even if you look at tax codes and certain court rulings, even someone like yourself who's in the mortgage business, who's in the lending business, can still be considered a real estate professional, right? You can be. It's not always the case. You can be, depending on how your entities and your incomes and your time's allocated. But yeah, sure. Lending, title, real estate, property management, all of those that are involved in the real estate aspect can be considered real estate professionals. So yeah, okay. In fact, the clients that are active in real estate and real estate agents, things like that are my clients, they're the ones that pay the fewest amount of taxes that invest in the real estate.
Nice.
Yeah. You know what's crazy? I've heard like this conversation from several different accountants, and every time I'm just always fascinated to like watch it walk through of where we're going and just hearing it over and over again, the power of real estate, how it works. And not enough real estate investors. And we all start investing in real estate because, we want cash. And you don't realize all these benefits. But as you start to learn these benefits, these are real things. They're not only real things for yourself, but if you start taking on capital from investors, these are real conversations that you have to have with them and discuss these exact tax things, even though we always say, hey, consult your tax advisor, accountant, whatever you have, CPA. Real quick, because we do want to ask you some 2022 tips and tricks. But before we do that, and this is a case for yourself, can you define the difference between a CPA, an accountant, and a tax preparer? Because I think too many people get involved in real estate and don't pay for the right tax professional to manage what they're doing.
Yeah, I think this is a really good question. So there are I'm kind of going opposite here. There are 4 different kinds of individuals who can, I'll start with file a tax return with the IRS, right? Actually 5 if you take it this way. Any Joe Schmo can go file their own taxes by themselves, right? They have no representation. If anything goes wrong, they have to kind of figure it out on their own. Then there is a paid preparer. A paid preparer is someone who just gets a number from the IRS, an identification number from the IRS, and they can file a tax return. They do have limited practicing rights with the IRS, but nonetheless, they do have some practicing rights with the IRS. Paid preparers aren't always bad, but there are more bad ones than good ones. And then there's something called an enrolled agent. Now, an enrolled agent is actually something that is not known very well, but an enrolled agent is kind of like taking a CPA exam, but you take it with the IRS. So it's a rigorous test with the IRS. And as an enrolled agent, I have unlimited practicing rights for my clients, for anyone really with the IRS. I can do anything that like a CPA or a JD can do for their tax clients. Okay. The CPA is someone who has taken a test with the state and is certified through the state to represent accounting clients within that state. And there's typically reciprocity among states for that CPA designation. Okay, they also have unlimited practicing rights with the IRS for their clients. Now, the difference is what they actually specialize in. Because I know plenty of CPAs, and I am not a CPA, but I know plenty of CPAs who do not know a lick about taxes, right? Maybe they specialize in audit, or they specialize in CMA, or there's, the M&A. There's a few different ways that a CPA can make a buck. But when looking for an accountant, find someone who has a licensure. It could be a JD, an EA, or a CPA. Because they will be able to better help you in the event that something does go wrong with the IRS. But then just make sure that they understand the niche, or are even involved in the niche that you're wanting to invest in. I know very few accountants who actually own real estate, but I know plenty of accountants that talk about it, right? I know very few accountants who actually own crypto, but I know plenty who try and talk about it, so that just kind of my little 2 cents, if you will, my rant.
Yeah, that makes sense. And again, most people, they buy one house, they buy two houses, and then next they're a tax preparer because they're doing it on the side. It's like, oh, well, I think you could do this. I'll tell you, one of the biggest changes we had was going from, and our guy knows, I love the guy to death. Worked for him for a while, and then he was doing our taxes for us, and I was like, hey, Matt, we got to move on. But he's like, no, you need to move on because I'm not doing you a service. I'm doing you a disservice. And there's not many. Everybody just wants the business rather than actually doing what's right for their clients.
That happened with ours too.
Yeah,
we outgrew them.
And I feel like I'm pretty. Accountants, doctors, lawyers, they're all kind of like know-it-alls. They feel like they know everything. They're really educated individuals for the most part. But I think that is kind of the one downside to my profession is they are kind of like, oh yeah, I can do that because it's a tax matter, right?
Right.
That tax matter could be anything from M&A to capital gains to ESOPs to business to, I mean, there's such a wide variety. And I feel like I am pretty good about, for example, I had someone reach out to me yesterday about M&A, mergers and acquisitions. He's selling a company. He's actually been a client of ours. And I said, look, M&A is not my specialty. But here's someone whose specialty is M&A. For this specific purpose, I would have you work with them, So I feel like, yeah, it does get to a point where we are like, okay, you have definitely, we have some clients who outgrow us. It doesn't happen too often, but it does get to a point where we are like, hey, you really need to have someone in-house, right? We'll work with $1 to $50 million revenue companies. And we're like, okay, you have gotten to a point where you're 50, 55, 60, it would be much better for you to have someone in-house who's managing all of this for you. So,
yeah, that definitely makes sense. What, speaking of being experts in the topic, and you've obviously expressed your expertise in accounting for real estate, what are some 2022 tips and tricks, that you got up your sleeve, or new codes that have come out? I know it's kind of early for 2022, but some things that should be highlighted for real estate investors to pay attention to, besides them trying to take away 1031s this last go around.
Yeah.
But some stuff that we can do to protect ourselves, whether it's on the active or passive side.
So we are kind of early, but I also don't think that they're going to do much more with the tax code right now because of midterms. I think if midterms weren't a thing right now, there might be some changes. Other than that, the biggest change right now that we could experience from a real estate perspective is a step down in your bonus depreciation from 100% to an 80%, which does take a little bit of effect. But even then, you can still take advantage of things like a cost segregation analysis or accelerated depreciation on certain aspects of improvements, upgrades, things like that, capital expenditures. Those are the biggest ones. Like I said before, because of midterms, I don't anticipate them making any major changes this year.
Yeah.
Unless they whip one out, which they could, but who knows?
Oh, then again, well, I guess we shouldn't talk about economy on here. But speaking of which, let's could you talk about, because we're legacy owners, I think is the best way to put it, right? Like we're long-term cash flow guys. Whether it's with us or we have capital investors who invest with us, it's a legacy for us. Can you discuss stepped up basis and just kind of what that looks like for some people? hey, you're older, you're getting ready to pass your real estate to some family members, or you want to plan for it, some things that they should know about that. Because I think that's a big thing that a lot of people don't know about.
Yeah, which would actually be, so this is, that's a great segue, because we've covered how you cannot pay taxes now through real estate. We've covered how you cannot pay taxes when you sell or exchange your real estate. The final way that when you would be taxed on your real estate is upon expiration. I feel like that's a good word instead of saying death all the time, right? But when you die, right now, the way the tax code is written, and I say that because it could change. You never know, but it could change by the time 83 of us pass away. Right now, the way the tax code is written is you have a lifetime exemption on your assets that you pass down to your beneficiaries. Okay, right now that exemption is like 11 point something million dollars per person. That was one thing that they had actually wanted to change in the Build Back Better bill. They wanted to have that step down to about 5 million per person, but that does not include your real estate. The way the tax code is written right now, if or when we expire under current law, your beneficiaries receive a step up in basis on the properties that you own. Okay. Now, why is this beneficial? Because through real estate, and they receive that to a fair market value. I will add that. Okay. Why that's important? Because Ian and Jason could go be purchasing hundreds of thousands of dollars of real estate every year and exchanging that hundreds of thousands of dollars of real estate every year for the next 20 years into tens or potentially hundreds of millions of dollars of real estate. And upon your expiration, your kids receive an asset at fair market value, which becomes their basis, that they could then turn around and sell and not have to pay taxes on the gains of that property because of that step-up basis.
Yeah, that's huge.
And is that inclusive of if you've invested into syndicates?
It does not.
Okay, so you need to be the sole owner
because those syndicates are, all of that is passive income. Essentially, you're not selling the real estate, you're selling your ownership in the real estate, and that would be part of your lifetime exclusion, the ownership in the real estate at the fair market value of whatever that ownership is at the time that you expire.
That makes sense.
But there are now there are some things. And I'll preface that by saying there are some things from a planning perspective that we can do to mitigate or reduce some of those taxes. A lot of that would be working with an attorney to make sure that your trust structure is correct, making sure that we can add kids to the ownership in LLCs that maybe own some of these investments as passive investors or non-active investors in these LLCs. So there are some things that we can do, but no, that specific question doesn't fall under that step-up basis.
Yeah, this is great, Brady. I mean, that's some really good information, some advanced stuff, some basic stuff. Anything else you think that's important before we wrap up for just the general real estate investor to kind of think through?
Yeah, I always go back. In fact, I was talking with an individual, Losi, and we were talking about a bunch of different strategies yesterday, and he kind of ended with the same question: what else should we know that we don't know? I always go back to the very most fundamental thing about taxes, and that is your documentation. Working with a professional to make sure that your entities are correct, so that you're not going to have to pay a lot, or you can help reduce taxes through entities and liabilities taken care of. Again, I'm not an attorney, but I know enough to be somewhat dangerous. But your documentation is key, whether you're wholesaling, flipping, or real estate investing. Your income, your expenses, depreciation, things like that. Your documentation is key, just because that's what's going to help protect you if, and dare I say the word audit, but if you ever get audited, right? And that would be my biggest thing. Is it's so easy to make tons of money. It's so easy to make tons of money and not have to pay taxes. But having someone on your team that understands that is key.
Yeah, that makes sense. Great. Brady, where's the best place everyone can find you on the internet? Or how can people reach out to you if they're interested in having a discussion with you?
Yeah, follow me on Instagram at the Brady Slack on Instagram. I try and put out half decent content half the time. So I could be better at that. I'm on Facebook, Brady Slack, or you can shoot us a text at 801-747-9829 or send us an email, info@highcountryfinance.com.
I'm going to put that in the chat too. So highcountryfinance.com.
Yep.
Well, we did forget. I'm sorry because time is precious. We're coming up on an hour, so I didn't mean to rush you off here, but I know Jason's got a question that we ask all of our guests, so you're going to have to answer it. So Jason, go ahead.
What's one of your favorite books? I don't know if you read books or if you listen to podcasts, but what's a book that you've read recently, or maybe a podcast episode that you recently have listened to, or that you'd recommend?
Because I talk about tax, I have lots of favorite books. I'm reading one right now on how to what's the name of the title? How to Make Friends or How to Keep Friends or whatever that one is. But the one that I always recommend is Tax-Free Wealth. Tax-Free Wealth is written by an individual by the name of Tom Wheelwright. He's a friend of mine, and he's Robert Kiyosaki's tax accountant. I've spoken on stage with Tom. I'm in his accounting network. I actually teach his accounting network about kind of energy credits, things like that. But that book is incredible for kind of the entrepreneur, business-minded individual on how they really just anyone on how they can make more money and pay fewer taxes. And his podcast is called Wealth Ability, one word. And he's got some great content on his podcast as well. He's actually coming out with a new book. It's set to launch. His pre-launch is actually in a couple weeks, I think, and I'll put out a shameless plug for Tom. I really enjoy him. But his new book highlights 7 different ways that people can partner with the government to amass large amounts of wealth and not pay taxes on any of it. So it'll be a really good book as well.
Yeah, he talks about some of that in his Tax-Free Wealth book as well. I read that earlier this year, and I'm looking on this the PDF of his companion file as we talk, because I downloaded that and I haven't really fully gone through it, but I got a lot of value out of that. It's a good,
wonderful book that highlights a lot of the tax strategies we talked about today. And like I said, I put that shameless plug out there because I know Tom personally, and he's a wonderful individual. So
that's awesome. All right, Brady. Well, we certainly appreciate it. I think I personally got a lot of value. I know Ian's shaking his head. He got a lot of value as well. And
I'm just happy that I'm happy.
Conversation with his wife now about becoming a real estate professional.
That's what I was going to say. I said, I'm just happy Jason's wife got a job. I'm so excited.
She might not be, but he is.
Yeah, I mean,
she's going to kill both of us. So,
well, I've just been thinking through some of the things, and I don't know. I mean, a lot of the stuff, we used to own a lot of real estate, and we sold a lot of it early, right after COVID, and we got a premium for it. And we use those funds to to invest in lending. We're an LP on a lot of different things, but that's typically like our plan for buying more real estate is more investing on the LP side. So I'm not 100%. So I don't know. I got to think through that in my head.
No, you're good.
All right. Well, we certainly appreciate it. We'll keep in touch, and maybe we'll have you back on here in the show. Maybe we'll do another follow-up with this, in a few months as well.
Yeah, closer to tax season once some tax codes start dropping, I think will be appropriate. So
yeah, I'd be happy to help in any way. Thanks for having me on, guys.
Thanks, Brady.
Thanks. We'll chat soon. Cool. So hey everyone, if you like this content and the content that we're doing, Ian and I have a lot of fun doing this. We kind of have a joke that if we're not talking publicly on camera, we just be talking to ourselves about this stuff because this is fun for us. And we'd certainly appreciate if you could give us a quick review or a lot of people watch this on YouTube, a lot of people watch it on Facebook, a lot of people listen to it on iTunes. However you're watching it, however you're listening to it, if you give us a quick review, we'd certainly appreciate it, and share it with a friend who also might find this content valuable. And we've got some upcoming guests here in the next week or so. So we've got a lot of new podcasts dropping soon. Hopefully you guys liked this one, and give us a thumbs up, and we'll continue to do it. Thanks, guys. Chat soon.
See ya.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time,